We're preparing to live stream. This meeting is being live streamed. All right, welcome in everybody. This is our Chit Chat Money Investing Power Hour. I am joined today by my co-host, Brett Schaefer. Let me make sure I always botch the audio. That's a guarantee. That happens every episode. Um, I'm joined by my co-host, Brett Schaefer. The structure of this episode is we can talk anything financial markets. I guess it's a fairly busy week. So anything's fair game, and then these are live on YouTube. So if you just YouTube Chit Chat Money on Thursdays at 4 p.m. Pacific time, 7 o'clock Eastern time, you can catch these and ask questions if you want to. I know most people just end up listening to this in podcast format, so to each their own. But if you ever want to get some questions in, we love getting them. We have a couple of actives that are constantly there, so always appreciate them. Brett, how are you today?
Doing well. Weather's awful up here, and yeah, it's getting to the boring part of the winter, but no one needs to hear about the local weather. Two housekeeping items. One, subscribe to the newsletter. It's free. It's in the show notes, and it'll help you out basically. Well, not help you out, but it's great info to go along with each episode. And again, it's free and easy to sign up. You get a lot of show notes and information along with each episode um, into your inbox. Two, we're going to start talking about just remembering if you like the show, give it a 5-star review on either Apple or Spotify. It takes you about 5 seconds, and it's the easiest way to help us grow. Because sometimes we get some mean reviews in there on Apple. To be honest, we'd like to get some nice reviews in there. So if you enjoyed the show, give us a nice review and a 5-star comment because that can help more people go to the show. But I'm going to tweet out the link to this episode. And Ryan, do you want to talk about our sponsor who's doing a great deal towards the end of 2022 as we wrap up the year here?
Yeah, I think pretty much everyone that's listened to this podcast knows the name by now, but it's Seven Investing. They're exclusive sponsors, and I've said this now on a couple of episodes, but I know not everyone listens to every single one, so it bears repeating. They have a deal right now that's you literally get the whole service for free. So it's a 1 week trial for $1, but if you use the code money, you get that dollar off, and then you also can use money again for the annual if you decide to subscribe for the year. So I this is the best time to at least check it out and try. I can't think of better value because it's literally free. Um, and I mean, you mentioned this before, but you're bound to find a company in there that piques your interest because they have, for one, they have such different advisors that cover such different topics and different expertises. So you might not agree with every single pick, but there's got to be something in there that's bound to potentially be a good idea and something that really sticks with whoever the readers are. So really recommend going and checking it out. The code is money. You get $100 off the annual, and then obviously you get the trial there for free. So free week. Go ahead, check it out. But that's gonna do it for the sponsor. Let's talk financial markets. Anything big this week that like anything glaringly obvious that I missed?
I don't think you missed it, but I have the huge thing with the semiconductor plants in Arizona with Taiwan Semiconductor, Apple, AMD, Nvidia, and I'll hit that on my topics. But besides that, earnings have been kind of slow. We're in the software period. So if you're kind of in that, we had some MongoDB reports, Snowflake, a few
Today was the
others.
retail one. Today was big retail. Chewy, Lululemon,
That, that's right.
DocuSign reported today. Let's see how abysmal those were.
I think it was up actually, but expectations have been quite low. That is a bombed out stock. So
Yeah. No, it's actually, I mean, it's it's like a great core business, but that's just one where like talk about COVID resetting expectations. There was if I'm reading the Glassdoor reviews right, it sounds like the entire sales staff failed to meet their quotas this year and quit. So or at least that's at least what the disgruntled employees made it sound like. And then the CEO obviously left as well. So uh it just goes to show how important it is. I think maybe more so than anything else, the role of a CEO is to manage expectations.
Maybe that's, I don't know if that's number one, but it's
Strategic direction too, but
yeah, I'd say capital allocation is number one, but that managing expectations is definitely important.
it's got CFO written all over it.
I think you want, well,
Maybe for internal investment, CEO capital allocation matters, but
I
letting the
think,
CFO run buybacks.
yeah, well, it's more than just buybacks.
Yeah.
It's more than just buybacks.
All right. Should we get started here? I've got some pretty interesting news, but I'm trying to pull it up on the computer that I am doing video on. So let me get there. Block had basically this, I don't know what to call it, sort of a Cyber Monday, Black Friday review, because they work with so many retailers, and so they kind of gave this comprehensive review, except it was like not all that comprehensive. Like it was a lot of pieces of data that like didn't give me a very good glimpse at what was actually like happening in the retail space. So the news was Square and Afterpay sellers, so between the two ecosystems, the sellers that are associated with each one, saw more than 61 million transactions during Black Friday and Cyber Monday shopping weekend. They didn't say whether or not that was up or down from last year. Maybe it's because Afterpay wasn't integrated last year, so it's hard for them to tell, but it sounds like a lot, I guess, so that's good. The other thing they mentioned, Square payroll labor data shows a 19% increase in holiday staffing, with employees clocking 3.8 million labor hours. Sounds to me like margins are compressing, but
Oh, say that again.
Basically they said labor was up 19%. Employees during holiday staffing was up 19%. I assume that's year over year. It doesn't actually say that explicitly. The other thing they mentioned here, transactions of buy now, pay later methods through Afterpay grew 120%. And then I was like, wow, I can't believe it's still going that fast compared to pre-holiday across online and in person.
Well, that's got to be an easy comp. I wish they would give to last year during the same time period. October, November, just totally different periods for retail, as we all know, especially in the United States.
Yeah, and then I guess a couple of other. Okay, so and I don't know if this is year over year data. I think it is, but if they're comparing this to pre-holiday, I don't know. It's such a meaningless comp. All right. Fastest growing Afterpay item categories. You may have seen my tweet, but can you guess what the fastest growing category is?
Well, I just clicked your link, so I have it up. So spoil it. I don't want to spoil it. Tell the listeners what it is.
Okay. Food and beverage use of Afterpay for food and beverage items was up 251%. Would that not concern you if you were a lender?
Maybe it depends on what. I guess it would be hard to get this data, and you won't know until it is concerning. But maybe people are just using it in general, and they kind of have their 2 week periods that they're replacing it with a credit card for, where people don't really scoff at, people using credit cards to buy food and beverages. So maybe it's not that big of a deal. And yeah, this is going to definitely drive revenue growth, right? But yeah, if people feel the need to do layaway on a sandwich purchase, that's not. I guess we'd have to see more data, but it's potentially concerning, right?
Yeah, yeah. Maybe I'm overthinking it. And I probably am, but when I read that, I think, okay, they need an installment loan to buy their cup of coffee. That's not,
I don't
it's
know if
not,
it doesn't have to be need. It could be need,
it could be them just
but
replacing their credit card. Yeah, that's true. That's one way to look at it. But why is it just outpacing every other category so much?
a lot of advertisers out there
I suppose.
putting it at they're putting in a lot of marketing dollars. Who knows? It
All
seems
right,
like
well,
there's just a narrative that out there that younger people don't like credit cards, and this is basically the same thing with different terms, right? But younger people seem like our age seem to like this better. It's showing up in the data, but who knows? It's kind of pick your poison, right? You're still taking out a loan to buy a consumer item.
Yeah, you're deferring expenses. All right. This is maybe a little more interesting. Trending Afterpay search terms. The highest trending were PS5, number one, gift cards. What? That's not even, no, Nintendo Switch was the second. Sorry, they've got these out of order. Nintendo Switch was the second, Xbox was the third. Those were all up 100, basically double. And then toys and gift cards, 30%, 40%. It bodes well for video game industry, at least. And we
I think
saw
so.
some data. We saw some purchasing data around the Switch console, the PS5 console, and the Xbox console, and all seem to be doing really, really well compared to last year.
Yeah,
Maybe
I can maybe find that data for the United Kingdom and yeah, but yeah, keep
I
going.
guess that was just the UK, yeah, but that's we own a couple of video gaming companies, and anytime you can see them actually meeting demand, it's a little more satisfying. It's still one of those areas where so many people can't get it, despite the
Yeah,
desire to get it.
yeah, the supply is just going to be slow. There's not much else to discuss there, right? You can't build 20 million computers, which is basically what these are, computers that are built for gaming within a month. It's going to take a lot of time, and once you get that backlog, I think it's really hard to come out of that because it's not like you can just double it in a quarter. You have to really, really ramp up, and then even ramping down is slower. So it's going to have to just be over time. And hopefully this holiday season is the end of it, just for the gaming world. I mean, kind of normalize, but we'll see. It seems like supply is still a bit constrained. And let me try to find that while if you keep going, if you have any more info here.
No, I mean, that was basically the gist of the report. I think you get probably a lot more from Adobe's Cyber Monday, Black Friday weekend wrap up, because they kind of have analytics on basically the entire e-commerce space. So uh, it's a little more useful potentially. The only other item that I brought to the table, and I guess it wasn't the newsiest week for me, but the Airbnb, I don't know if you saw this, but they launched like an apartments tab.
I did, or
It's like a part,
partnership, right, or something like that.
yeah, it's like a section where you can find Airbnb friendly apartments. So in a way, it's kind of going after a new demographic of renters as opposed to just like vacationers, where you can browse if you're looking for a place where you want to be able to rent it out for 2 weeks out of the month or a week out of the month, and you want to have that flexibility. A lot of apartments don't allow it. But Airbnb's basically created the dashboard to go find it. My thought here is that this is going to encourage apartments to be more accepting of it, which,
Yeah, because it's competitive where renters are going to want this option.
yeah, and now they have a directory to find them.
I definitely want this option. I actually looked up the Seattle area. Not really. There's only a couple, so limited supply right now, which I guess is to be expected. But for both of us, as two people that don't have, um, we're not tied down to any, in-person work, we would have the ability to leave and maybe take a month somewhere else and live somewhere else, probably on Airbnb, maybe one of the other platforms, and then rent out your apartment. You're not, paying double rent and stuff like that.
yeah. And I mean, it just makes, I don't know, it makes living there more affordable, especially if you have like a 2 bedroom and
Yeah,
you're not using them both.
that's a good point. I didn't think about that as well. It can really help with just, I think it can really help with supply and demand issues as well. I know Airbnb has been, people complain about that being bad for supply. Um, because people lock up places that they only use for short-term rentals in certain areas, and then long-term stayers and renters and homeowners kind of get a restricted supply. But I think with this, it can really help out because there's definitely a lot of people in our shoes as well who could utilize these features.
Yeah, agreed. I hope it makes renting more affordable for a lot of people. Plus it boosts inventory on Airbnb potentially if more apartments adopt this solution. The other thing I was thinking about with Superhost, and I see this all the time because there were a lot of people that took advantage of the low rates where they basically levered up, bought a whole bunch of places, rented them out via Airbnb. How do you think a rise in rates impacts not only those people, but Airbnb ultimately?
Ooh, well, this is an impossible question to answer, but I think we can try. We'll try to work through it. I think their average nightly rate could come down. It's gone up a lot over the last year or so, and I think that's just with housing and whatever affordability and all that stuff going up a ton as well. I think they could definitely be impacted in the short run if there's a lot of supply out there, and
Wouldn't this hurt supply potentially?
what do you mean, rates or?
Yeah, rise in rates. Well, I
No,
guess
I think
assuming
there.
that they financed them at low rates and it's not variable.
Well, you mean hurt supply for who? Like, would supply be going up or down?
My the amount of places on Airbnb with wouldn't they go down? Isn't that's kind of my thought.
Maybe, but there also could just be a lot of the people that came on um, giving out big discounts, which would lower the daily rates. So we'll see what happens. So I think there's a lot of variables at play there. So I think in the short run, daily rates could get hurt. Um, but we'll see. We'll see. It seems like that whatever it was, I think it was a 30% or maybe 40% bump in average daily rates will be, that's definitely not sustainable. And I wonder if it's going to revert back. Um, Here's a question though. Do you think the one of the hardest questions I think investors have with Airbnb, and I don't think anyone can answer this, is how many, if you could ask and make any sort of prediction, how many dollars in GMV will be flowing through their platform in 2030? You could easily, you could easily envision a world where it's a trillion a year, right? I think they're at like 130, but I'll confirm it. But there's also a world where it's maybe only 200 billion, depending on how people adapt. And I guess a lot of it comes down to the company execution, but I just think it's really interesting to follow this business, even if it's building
I
out
think a
its
lot of
own, it's building out its own, it's not replicating anyone. This is a whole new business model. So we don't know how large this market is.
they're untamed. No,
Good, yeah, the good point.
the also I think it's kind of dependent on rates, would be my guess.
For volumes, yes.
No, not the, I mean, I don't think people are going to be buying as many houses and just flipping them and making them available on Airbnb when you have to do it at an 8% mortgage.
Maybe, but I don't know if that means their daily rates are going to go up.
No, but I'm saying that that's going to hurt their ability to get to a trillion in GMV if there's just simply not enough supply.
Yes, but I think that's logical, but I just don't. Life will find a way, I guess. Is how I'm trying to describe it. If there's demand, it'll get there. They'll force it onto the market.
Yeah, I suppose. I like Airbnb. Don't like the price, but
Slightly expensive, yeah. Let's see. Last quarter, just for reference for the listeners, G gross booking value of, oh no, it's under 100 billion. It was 15 billion last quarter, so they're at about maybe, well, there could be some seasonality. Let me look at Q4 last year, but they're at about 60, 70 billion maybe.
all right. Let's talk chips.
Yeah. Okay, yeah, under $50 billion last year. Yeah, we'll get to my topics. Really came in with a lot of notes here, Ryan, today.
I've got
Let's
some
see.
talking points.
All right. There's also a fun one I have at the end. I'm also what was the other one I have? The Blackstone's REIT called BREIT. It's a weird name, but we'll get to that. Very interesting story. And then also there's a good tweet about Ponzi schemes that had a funny response. Okay, but this is a good serious one, probably the most interesting topic from the last week, and that is Apple, TSMC, and other chip designers banding together in Arizona. TSMC, which is Taiwan Semiconductor, the largest semiconductor manufacturer in the world, along with the president of the United States, announced an expansion to $40 billion of investment into the state of Arizona for factories, while the previous number was just $12 billion. The first plant is set to begin production in 2024. The new plants will actually have more advanced nodes than previously thought. They will have a 3 nanometer one by 2026. And right now, the leading edge is 5 nanometers. So these will be pretty close to the leading edge. And if we look at their customers, Apple, AMD, and NVIDIA are going to be committing to purchasing from these factories. And for reference for kind of the global supply, this will be enough supply for current US demand for computer chips. Now in 2026, 2028, US demand for computer chips is probably going to be higher. We'll see, I guess. But it's a sizable amount. And this doesn't take into in fact Intel, other companies that are manufacturing in the US. Intel is committing, I think, $40 billion as well to Ohio to build out factories there, as well as Arizona. Can't remember the exact numbers, but they're in Ohio and Arizona. TSMC is just in Arizona. I think the big thing here is there are $52.7 billion worth of potential subsidies because of the CHIPS Act passed by the US government. And I think that is just why TSMC is going aggressively here, because they're hopefully going to get, some free, whatever it is, tax stuff. However they're going to get this money, some of this $50 billion, and it'll help them build out these factories at even better returns on invested capital. I also saw that TSMC founder Morris Chang, he did a speech there. It seemed to be a who's who. You had Chang, President Biden, Tim Cook. What's the AMD? What's her? Lisa Su, I think she was there. I'm sure the NVIDIA guy, who is a very loud man, he was probably there doing a nice speech. But the TSMC founder, Morris Chang, at his speech said that globalization is, quote, almost dead. Get a comment here from Matt H, who again is leading the chat. Thank you for being the one person that watches on YouTube. He says, how pissed is Xi about this, referencing Xi Jinping? I think he's probably quite pissed. And this seems like an interesting counter move for Apple, TSMC, from all these China worries that have been popping up. So, any thoughts on there before we go into? I have a couple questions about these companies from an investment perspective.
No, I just simply don't have any takes on the semi-manufacturing space, just because I feel like it's always that area where I'm disadvantaged in terms of what I know. But I have to imagine that President Xi doesn't feel very good about this. And do you think this would have happened had it not been for him?
For being aggressively saying that they're going to, or leaking, or reports out there that they want to reunify, quote unquote, Taiwan this decade. I think
I keep thinking like,
TSMC and Apple are probably talking like, all right, you guys seeing this? Like, we need to get, these factories take multiple years to get ready. We need to do this now. Commit the dollars. The US government is going to give us a boatload of money. Let's go.
Yeah, to me, I think she is pissed about this probably, but
it's his own fault.
Time,
yeah,
like he probably forced this, or at least forced it many years in advance. But don't you think it's more costly in the US, or are the subsidies going to get rid of that?
We'll see. I mean, it's not, semiconductor factories are not based off of low cost labor. It's all about technological science. The reason that TSMC's core factories in Taiwan are so good is because they have the smartest engineers within that space there. They have the smartest scientists and all that stuff, and they have the contracts with ASML who do a lot of the R&D, I guess, for them essentially. So I don't think low cost labor isn't a thing. Low cost energy is probably important, right? Which the U.S. has some of the lowest cost energy in the world.
Yeah, didn't you say Arizona has a water problem? And
I did tweet that, but someone I tweeted that out so people would maybe respond and show that it wasn't a big deal. I think there's a lot of numbers that get thrown around about these plants using a ton of water, but since a lot of it just gets recycled. So some of those numbers are inflated, but they do use water. But again, Arizona, I would think that Apple, TSMC would have that sorted out. So I think they have these water treatment plants and these recycling facilities for them, but they're super energy intensive. So you want low cost energy. US has that. And especially in the Southwest, there's tons of renewable potential. And then you just got to get the scientists and engineers over here. I would think TSMC would be able to bring those over to the United States, and there would be enough from American colleges to fulfill that, although we'll see.
so what are the investing implications?
Yeah, so these are the questions I wanted to ask. Does this make you more bullish or bearish on first one, Apple?
Bullish.
I agree. I think it's pretty obvious, but what are any? Yeah, I want to see if you have the same thoughts as me.
I mean, it takes the component in their supply chain is the risk is assuming that it gets up to any sort of level to what they have in Taiwan, it completely diversifies away the risk geographically from being in Taiwan.
Yeah. Now, I think 90% of their manufacturing or assembly is in China still. So it's going to take a lot of work to get them out of the country if they really want to. It'll probably take multiple years. But yeah, I'm in the same camp. It would make me more bullish. However, though, you can maybe flip that and say, in the short run, they are exposed. So like they're making the right steps, but it's because they made mistakes 7 years ago.
Yeah, I also wonder how this now puts them at potentially a not so beneficial relationship with President Xi, or maybe not as amicable, I should say.
Yeah, in conflict, yeah.
Which, if that's where I think this would really hurt them in terms of gross margins, would be if their actual like labor side had to be repositioned somewhere else.
Yeah, we saw that Foxconn stuff. Yeah, that's interesting.
A lot of people would be getting Google Pixels.
Potentially.
Except they're probably manufacturing over there too.
Yeah, I think a lot of people wouldn't be upgrading. That's the thing. A lot of people won't be upgrading. It's just a huge risk, and I just don't. Again, everyone loves Apple. I've said this many times, but I don't understand the multiple it gets because of these risks. I really think it deserves like 10 times earnings. But
I'd take it at 10 times, but yeah, there is some risk.
Yeah.
It is like, if anything in their operation ceases them from cutting out upgrades at the same pace, you're going to see a huge crunch in the multiple.
Yes. Yeah. Yeah.
Like if there's, God forbid, one day President Xi said, "We're done manufacturing your phones,"
or he pulled an H&M and said, basically, I don't know what they did, but they.
Oh, I've read into that. Yeah. They like basically cut them out of like all search.
Yeah, something like that, and even more. They have the really authoritarian state internet capabilities and stuff. You guys, listeners, know what I mean there, where they can basically influence everyone to stop buying that's whatever H&M. I wonder if they could do the same as Apple. Apple's got a stronger brand than H&M, but I think that could be a risk in retaliation because one, China wants to make homegrown semiconductors, and two, the more people are buying iPhones from them, if the manufacturing isn't in that country, they're not benefiting because all the profits are going back to United States corporation. I don't think he would like that. But again, we are not in conversation with Xi Jinping, so who knows for sure? He may not be thinking that at all. All right, next one. Does this make you more bullish or bearish on Taiwan Semiconductor TSMC?
That one feels like a no-brainer bullish.
Yeah, already at 10 times earnings ish. Well, it popped after Buffett bought it, so maybe it's a little higher now. The big risk was the China invasion, and it seems like 5 to 7 years from now, they could really mitigate some of that risk.
Yeah, 100%. I feel like that probably the China invasion risk, I think, I'm guessing cut their multiple in half of what it would have been had the risk just not been present.
Yeah, because the market share, the almost monopoly.
And it's far more, and correct me if I'm wrong, and you might not know the answer, but it's far more durable and less cyclical than being the chip designers.
Yes and no, I think, because they can. No, that's interesting. They're still at uh the whims of what the end market demand is. So if smartphone demand goes down or cloud demand goes down or AI demand goes down, if that all goes down at once, then they'll be hurt. But yeah, like an Nvidia on its own, who might have a subsection of the market, they were big exposed into cryptocurrencies, that would impact them way, way more.
But how far
That could be much more cyclical. Where I think TSMC is exposed to almost all ends of the semiconductor market, at least all ends of the advanced semiconductor market.
isn't their backlog huge though?
Yes, but the backlog, there's a lot of companies that double order to try to get preferential treatment, stuff like
That
that.
can
So
just pull back on it.
also it can still be cyclical. Remember when earlier this year we were talking about backlogs at and supply at all the cars manufacturers, right? And how that can get fixed really in a shorter time than people think. But TSMC, yeah, it's cyclical, but they have a it seems like they have a strong moat. We don't need to go through the investment
Can you
pitch on T.
guess what TSMC's revenue CAGR has been since 1994?
Oh, I think I know this. 17%.
Correct. I guess it's on their homepage.
Yeah. That wrote enough while they
Earnings have not outpaced them.
No, they reinvest so much. They are in a huge capital cycle. But margins are up significantly. I think it's impressive what their margins are. They have their ability to negotiate with people, even like Apple, is impressive.
They paid 9.5 billion in dividends in 2021. What's the
Yield's
yield?
like 2% right now, I think. Something like that. They don't buy back
2%.
any stock. I can see why Buffett liked it though. It went down into his 10 times PE kind of strike zone. The share count's flat. They
3%.
reinvest almost all operating cash flow into new CapEx though, which has worked out wonderfully because there's just an insane amount of end demand to grow. All right.
All right, let's take this question. Is Google search dead?
Oh.
Or should we say it how it's spelled? Is Google search dead? With a little sarcasm in there. No.
You're referencing
the Chat GPT.
That's right. He's referencing the chat thing. I saw a favorite bear porn, the most popular bear porn Twitter account, say that I used GTP3 OpenAI, and they said Google search is long for this world or something like that. And I couldn't help but laugh because when the bear porn people are out there doing it, usually means we're at the top of the hype cycle or something. And I saw them they're like, what do you mean by that? And he's like, the account goes, well, I used it for 5 minutes and then it was pretty clear. It's like, okay, thanks. But I think it's important to consider these as a threat to Google because they could try to build a search engine type thing. We'll see what happens, but I'm pretty confident in Google's
You
competitive
used it.
advantages.
What
Yeah,
is
it's easy.
Google dead?
No, I actually was testing it out to see if it could write something like we do writing. I was testing out to see if you could do writing and have any sort of investment writing, investment articles, and have it make sense. It made no sense. Wasn't helpful at all.
Ah, brutal.
So they have not conquered the clickbait investment article writing yet. And to be honest, at first I was impressed, but I think like everyone else using it, I became unimpressed because I don't. A lot of the facts are wrong, so you can't trust it.
I feel like these things are so gimmicky. People use it for like a week or two, and then they go back to their old habits. Plus, I had to Google it to get there.
Yeah, well, that's
I mean,
fair.
that's doesn't matter. But the point is, it's always going to be the first thing I go to,
Yeah,
and
well,
90% of the internet.
to be fair, that Yahoo was the place a lot of people started out at and went to Google back in the day. So that is maybe if people are going to Google and then going to Chat GT, whatever it's called, GPT-3 or whatever whatever it is in general, that would be a threat because you want the most valuable thing is searching for stuff. But it's not write me an article about Dropbox's competitive position. It's hotels in Cancun, insurance policies, Seattle. It's nothing.
Yeah. All right. Blackstone's REIT, which I kept seeing that acronym. I didn't know what it meant. BREIT. I thought that had something to do with Brexit, but
Yeah, that when I was searching it, it started to come up with Brexit stuff. But I would, if you see in the document, Ryan, you can click that Twitter thread. It can maybe help you out a bit, but I'll try to go through, summarize some of the points for the listeners. It's a long Twitter thread, and maybe we'll, if anyone's interested, check that out. But Blackstone is going through taking a ton of heat this week for limiting withdrawals on BREIT, which is BREIT. It's their fund. It's not publicly traded. At first, I thought it was an ETF, kind of like those other publicly traded REITs or whatever it would be, but it's not. Apparently, it's private. It has $69 billion in assets, and the REIT is focused on the private markets. Now, the big question is, why are they limiting withdrawals? Well, we have to understand how the fund works first because it's a weird fund that Blackstone kind of invented over the last, I don't know when it started, but I'm sure this concept's been around before, but just stay with me. So this is not just for BREIT, but for all the private REITs out there. So a private REIT is the same as a traditional REIT, but do not have public price discovery. So a REIT is a real estate investment trust. They invest in real estate. They have to pay out dividends. I believe it's a 90% rate, and that's what qualifies you as a REIT, as a real estate investment trust. But the private ones are different because they do not have public market price discovery. Now, what this means is that
so what? The
they're
investors are just general partners, and they're just getting paid out the cash in hand privately.
ish or limited partners, I think you mean, but ish,
Yeah, yeah. Well,
sort of like that. You can envision it like that. But that what that means is that their NAV or the asset value of the fund is set by recurring appraisals, which quote unquote smooth the quote unquote volatility that would be there in public markets. So within this fund, performance has been great, and that's why they've accumulated $69 billion in assets. We had low interest rates, rising rents, etc. They weren't in commercial real estate, which was smart. So people really loved them and they went into the stuff that was doing well, data centers, industrials, rents, I believe, is what they were saying. And that's why their NAV has been soaring. And fees for Blackstone have been great. I wouldn't even describe it as great. I would say absolutely fantastic. So they they have quite a bit of fees here. So they have a 1.25% management fee. and then a 12.5% performance fee after a 5% hurdle, which isn't that bad. Each of those isn't that bad on their own, but I kind of combined, it's a little bit, that's a lot for both to have both of those. And then they have a hefty selling fee, which we don't need to get into the details there. Is when you sell, there's also a flat fee that gets taken out. And that is equated to for
At any
fund
time,
owner.
or is that
Yeah, if
like
you
after
take
a
it,
lockup?
say if you take out your money, I believe it's at any time, but again, the thread and all the information I found didn't confirm that. So I think just say there's a selling fee. And from what I should say the thread person's name, Phil Bach, who's a great follow on Twitter, knows this space extremely well. He said from his calculations, again, just maybe it was back of the napkin math, but it's just roughly right that these combine to 3.6% annual fees each year, which is a lot. But again, some of that is because their performance has been good. And then on that $69 billion in assets, that is $2.46 billion in high margin annual fees for Blackstone. So the big question is you have an investment fund who invests in real estate, but real estate is highly liquid. What happens if investors want to sell? So BREIT investors, or excuse me, the fund, they could sell some of their liquid mortgage-backed securities, and then typically they just use inflows to offset redemptions. But right now, the real estate market is totally drying up because of rising rates. Inflows are drying up and redemptions are heating up. So investors have tried to redeem at this high NAV because remember, they only appraise. I don't know if I mentioned it. They appraise the NAV or the asset value of the fund once a year. So right now, the NAV is stated at a much higher performance compared to all the publicly traded REITs. If you look at a chart that was shown in the thread, VNQ, which I believe is a Vanguard, let me just confirm the name for everyone. Vanguard real estate ETF. So just say a really broad-based Vanguard type ETF. That performance used to track fairly closely.
Share your screen. Share your screen.
Oh yeah, okay, I'll share. Yeah, smart.
Also,
Smart.
some comments in the chat. Bijan says, appreciate the content. You guys make a good podcast. Much appreciated. Then we've got a question from Tropical Storm, which we can take after this.
Okay, yeah, I'm almost done, but it's important because I think it's going to be a great example of asset liabilities mismatches. So if you look at this chart here, might have to zoom in. The publicly traded one, VNQ, has totally fallen off a cliff this year. Not as sharply as during COVID, but again, pretty sharply. But the BREIT NAV is only going higher. So real estate investors or REIT investors have tried to get out of this because they're saying, okay, they're seeing the writing on the wall. It's pretty obvious. Interest rates are rising, real estate prices are falling. The NAV is going to decrease once they do their appraisals. So they try to redeem, but Blackstone has decided to gate redemptions, and investors now have to wait in line to sell their stakes. At the same time, and Ryan, you're gonna get mad when I say this. I know for a fact you're gonna get mad. Blackstone is still taking fees out on this artificially inflated NAV. So, first question.
That should be illegal. That should be illegal.
Well, see, I told you, I knew you were gonna get mad. Not talking about the morality. Maybe we can get to that later. Can Blackstone sell properties at these appraised prices? Will this lead to a run on the bank? With a timing liquidity mismatch. We got a question from Matt H. How do you protect your peace with 500 tabs open? Yeah, that's how I go.
I think it's mentally insane, but
that's how my computer's big. It's only 20.
That's insane. That's so I want to be able to focus. Especially now they've got like the notifications that pop up on the tab.
I only got one open at one time.
It's criminal. All right. To answer your question though, no, obviously I don't think, who are they going to sell them to at appraised valuations? The only people they could sell them to is another subsidiary or fund that they start.
Yeah, Blackstone's their own fund. So the question is what happens? It seems like they're just delaying the inevitable. After
they conclude their quarter, they will let the redemptions go.
Once,
and then they'll guide down.
yeah, they'll take the NAV down and then people can sell.
You,
But
you let the quarter conclude, make the quarterly results look good, set expectations for next quarter, say it's the macro environment, and then guide down. And then
what
you let the redemptions come out.
what do you think Blackstone is thinking here? Are they just betting that interest rates aren't going to rise more? Because I just don't see this a way this doesn't end poorly and their investors getting either they lose a lot of Blackstone loses a lot of money. I guess it would be after earning a lot of fees, or B, their investors get pissed at them.
Mm, I would say B is a very likely scenario. I don't understand how they're still taking fees. That's the part that really pisses me off. And then,
Well, at the high price, yeah.
aren't there protections? There has to be protections for LPs in these scenarios where they can take it even if they have to have the high seller's fee. I wonder if they're completely holding withdrawals or redemptions, or they just have a ridiculously high early redemption fee.
I think that would have been talked about in the thread, so I doubt they have a ridiculous early redemption fee. But
But
I
how
think
can you?
it's the liquidity. It's the liquidity. I bet that was part of the contract that the investor signed. It's the liquidity where they could get a run on the bank if people try to redeem it. They wouldn't have the cash there. It would all be in real estate assets that you can't sell overnight.
But who cares if? Oh, oh, they just can't give them the money.
Yeah, exactly.
Blackstone hasn't. Okay.
That's
Oh,
why I think. That's why this just.
take some from the parent company.
Yeah, well, I don't know if that's legal, but
We'll
I don't know if this. Why? Who thought this was a good idea? I don't.
we're talking to John Rotanti on Monday about Blackstone.
That'll probably come out later in December. Or I know it'll come on later December. We'll see. If he has any thoughts on that, he knows the company better than us, but it's just one of their funds.
Okay.
Here's the question though
All
I
right.
have. Here's the question though I have that's more broad. Does this is a concept that comes up a lot. Does illiquidity deserve a premium valuation? People say it does
Why?
because it has smoother volatility. It's lower risk because of that.
It's not.
No, that's
It's
Ryan.
lower
I'm
risk
the
until it zeros. The
Ryan. That is the consensus. I'm only speaking what is the consensus out there.
No, of course it deserves a discount.
I know, but it's crazy that people think that public markets deserve
It
a
doesn't
discount.
deserve a premium. It gets one because they give it to themselves.
Exactly. I agree with you, but that's what they talk about. Yeah, or that's what they claim that because it's lower volatility, it deserves a premium valuation, which doesn't make any sense to me.
I mean, I guess it is lower volatility when anything non-public is lower vol.
I guess, but that comes back. Maybe that comes back to the definition of risk. Volatility is not risk. So that just show like it just I think is a clear example of why volatility should not matter unless you're leveraged, obviously. But
What's the expression? Volatility is not risk, volatility is opportunity.
yeah,
Volatility is fees for Blackstone or
no
lack thereof.
lack of volatility, low vol. Yeah, well, speaking of that, they had a whole thing with low vol funds, I think, a few years ago, but that's a story for another day.
Okay, let's take Tropical Storm's question. He says, what pond is more exciting to fish in right now, consumer staples or consumer discretionary? That's a good question, actually.
I
Gut tells me
feel
staples.
yes. I think this is a good time to start loading up discretionary ones for your watch list and then hoping they get cut in half.
I see how like sometimes I think recessions are fairly predictable once once you see the momentum going there. Maybe I'm wrong. Maybe that's a very naive take. I haven't really been through one. But you can see
Well,
the
COVID.
cycle. I mean, more of like, I suppose, but that felt more flash in the pan. It feels like once you start seeing the layoffs affects the purchasing power affects the top lines of the businesses, stocks
Operating
decline. The
operating
wealth
leverage.
effect takes.
Yeah, operating leverage goes
Oh,
down, margins go down. Yeah. Well, what's interesting is that the market does seem to predict it because I believe there's some studies out there that stocks start going up well before the recession or all the negative trends and for the global or the whatever macroeconomic trends you're tracking. So I think you are probably right, and that's shown up in a lot of studies that people have talked about.
I'm saying
Um,
if I'm going into if okay, judging from kind of what I'm seeing anecdotally, which is people reining in spending slowly, but it's happening. Layoffs. I mean, we're seeing them at a lot of businesses. I think purchasing power is coming in a little bit. My gut would say go with cigarettes over luxury couches.
yeah. And speaking of which, Matt has a comment here. I cannot wait to listen to the doom porn from the RH CEO on the call after this. He is very entertaining. That is
Yeah.
a good point. He is unlike a lot of CEOs, unlike 90% of them, he is unafraid to just say what's on his mind, which I think can be very insightful because he's not trying to BS you. He'll let you know how the company's doing. I think it's pretty fun to watch, although they do sell very overpriced furniture. Um, yeah, the consumer staples just I think seems safer in general when I'm looking at a consumer discretionary stock, unless it's someone like an Apple or a Nike who have multiple decades of brand dominance. I'm gonna want a discount.
Yeah. The
And
discretionary
any
stuff,
could well, go
I
ahead.
don't know any discretionary business that I love that I think is like insanely durable if it hasn't proven to be durable for like the last 40 years.
Yeah. Okay.
Tropical Storm says, I asked because my view is everyone already knows about the consumer stress and it's reflected in the valuations in many staples names where discretionary is valued lower for the same reason. Yeah.
That's right. Staples are a high multiple. Hershey's really at it's had a high multiple. It's one of my favorite ones I've looked at. It's been on the watch list. It's way above 20 times earnings.
I'd say, but at the same time, it's pretty realistic to potentially get an environment where earnings decline for several years on some of
Y-
the discretionary.
Yeah,
So it might be trailing multiples, obviously case by case, but trailing multiples might be misleading here.
that is true. They could be pricing in the earnings
And
decline.
those,
I think
especially the discretionary businesses that have been taking price over the past couple of years that aren't able to do that, that to me is going to be that's going to hurt operating leverage
yeah, I think
or
it's a tough
margins.
one. I think it's a tough one where if I'm looking at consumer discretionary, it's not something I typically like in general, but I do have some on my watch list and I'm really just waiting for a big discount. And then consumer staples, I'm looking for, well, it's a case by case basis depending on their earnings growth, but I'm for staples, I'm looking for something that's entirely discounting. Like, I think it's really tough. It's really tough because again, if you find a good consumer discretionary one, Nike, Apple, whatever, I mean, that could be a 100 bagger. So there is a lot higher, but again, Hershey is also a 100 bagger. So
I just like
it's really
Staples
tough for
more,
me. I like staples more as well. I also
less
don't
downside risk. It feels like
I don't like stuff. I always discount. We talked about this before, but I really discount stuff that's in the physical world, as opposed to the digital world, just because you probably have more labor costs. You probably have um, energy costs coming in, commodity costs.
real
Yeah,
world's outperformed though.
that's right. It has been the return of the real world, but that's probably because the discounts.
Revenge of the real world. All right, let's
Yes,
talk
the revenge
Ponzi
the
schemes.
yeah. We'll close this out for the last 5 minutes, but just before we say that, that's because the discounts, or excuse me, the spread between the digital in 2021 and 2020 was so absurd. But generally, all else equal, I would like a digital business better. But Yeah. All right. Let me pull this up. Is there another comment there, Ryan? Or
What do we think about highly or higher leverage companies with durable free cash flow that will be able to buy back their debt if the credit markets bomb out here? Yeah, I mean that's
ooh, interesting. Yeah.
love that.
Yeah, I
We're
haven't
looking at a
thought.
company. I was looking at a company today. The companies that raised in 2020, I would say any company that's raised below 4% or their total cost of debt was below 4%, and they're sitting at 10% for cash flow yields right now. I think, yeah, those companies are going to have really good returns for the next 5 years.
If someone raised in 2020 and 2021, that's an indication to me that the CFO thinks with a capital allocator's mindset, or CEO and CFO.
With the one contingency being that they generate durable cash. And I guess Matt mentions that here, but there are a lot of businesses that raised at really cheap rates that don't generate cash, whether that's by choice or whether that's by default. That makes, I mean, then it's terminal. Then the credit sucks for the lenders, but
Yeah,
as an
Carvana.
equity
I think
holder,
Carvana could have been that example. Cannot believe people are still in that thing, but we don't have time for that. Okay,
but it
here's a
does
tweet.
give. I mean, there are a lot of, I would say, really good forward returns on companies that are out there like that. I think just a few. I mean, we're talking about GoDaddy tomorrow. They did that in a really good way. They've reduced share count by, I want to say, like more than 10% over the last 2 years. They've got reasonable cost debt, and the
Yeah,
business is pretty durable. That's I was just looking at that all day, so it's the first one that comes to mind. But
no, GPT-3 is gonna disrupt them.
and to Matt H's point, that's something Michael Burry tweeted about a long time ago. He deleted it too, but he said coming out of this, the companies with low cost debt and durable cash, there's going to be plenty of good returns for investors to have.
Yeah. All right. Here's the tweet. Don't know if it was serious or not, but what are the biggest Ponzi schemes that almost no one wants to admit? And then they did the thinking emoji. Super cool. Someone said taxes. Someone said social security system in the US, the US dollar. And then they gave a nice face with someone like going kind of like well, I didn't see me right, but
I
anyone that's
see it. I
watching,
see it.
yeah. The taxes, crypto, Bitcoin. It was very funny responses. There's someone just the biggest galaxy brains out there where someone says, "Did you know before the formation of the US Federal Reserve, it was illegal to pay taxes?" Scary part. The Federal Reserve is neither controlled or owned by the US government.
That just doesn't.
Everyone, yeah, a lot of just not. That's just
It's
false.
just nonsense. All right,
Everyone kept saying social securities. Ooh, someone said private equity.
I'll take this
Oh,
one.
maybe,
I'll take
maybe.
this one. Cooking. Cooking, biggest Ponzi scheme out there. You spend hours prepping your meal and it takes like 10 minutes to eat it. I think it's unfair. It's unjust.
Hours? What are you making over there?
Okay,
Hours?
maybe not hours, but it always takes longer to cook it than eat it. So it's always the struggle and not enough reward. The
That's that's nonsense. But
what's more nonsense, that or the Federal Reserve as the biggest Ponzi scheme?
that is definitely more nonsense. Although I guess by
Right.
definition, people talk about the Fed being a Ponzi scheme. It's not. The U.S. like the government has a monopoly on printing money. It's not a Ponzi scheme. They could just print it. That's right.
It's actually not it's
It's
they're
no.
very
It's not
outward
a.
about it.
Yeah.
We
Yeah.
got another comment here. The chat is quite active today. Arpin Karana, I hope I'm saying that right, says, "Hi fellas, love your work, especially the deep dives. Any interest in deep dive on garbage companies or any chance you plan to cover railroads?" Those are interesting. We'd love to look at those. I admittedly kind of a novice when it comes to railroads and
We should do a
the
theme.
garbage companies,
We should
but
do a theme.
down for that.
Industrial garbage and railroad. We should do as a theme for a month in 2023. Let's mark that
Incredible
down.
moats on those railroad businesses.
That's
Incredible.
what I hear, but I haven't looked into them. Also, we're talking about inflation and cooking. and Ponzi schemes. Matt says Chipotle is now $50 a meal, so rocking a hard place on the cooking. That's a great callback from one of the tweets of the week.
See,
When someone, I think that person that tweeted that's very smart, but that someone tweeted out that a two-person meal at Chipotle is $50 now, which is not remotely true.
it's so
Um,
true.
I guess if you got a side and a drink, it'd
Getting like,
probably be like
can I get
35. But
6
that's also,
extras of chicken?
yeah, if you got double meat, guac, a side and a drink, which again, you don't like a side and a drink. That's just, you don't have to get that. Also, no one's forcing you to go to Chipotle. It's like people talk about Chipotle and how much pricing power they have. Like people are just forcing them to eat there.
Well,
Like
people
it's a,
go because cooking's a Ponzi scheme. It's so much quicker. I'm telling you. Why do
well,
you think they
right.
go?
You
All
should get
right.
long. You should get long some robotic cooking. What's the one that Chipotle
I
owns?
might
Chippy.
have to
The
fish in that pond.
Yeah,
All right.
seems like you really hate that. So
It's 5 o'clock Pacific time, so that is going to do it. Thanks everyone for tuning in. Thanks for all the questions in the chat. Really appreciate it. Really appreciate it. We do this every Thursday at 4 o'clock Pacific time, 7 o'clock Eastern time.
although it's gonna be Monday next week because you are on vacation.
True. Yes, it will be next Monday. Let me actually make sure I get the time right so everyone can tune in if they feel so inclined. It will be 1 second. 3 o'clock Pacific time. So 6 o'clock Eastern time next Monday. And then typically Thursdays, 4 o'clock Pacific time. All right. Thank you everyone for tuning in. Reminder, Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. We are, however, general partners at Arch Capital, so clients may have positions in the securities discussed in this podcast. Thank you all for listening. We'll see you next time.